So Fairway Independent Mortgage Company, fifth largest mortgage company in the country. You never, we're not a household name in New York because we only have 3 offices in New York. Part of my job is to develop New York and increase our footprint in New York. So we're working on that. Myself personally in the mortgage business, more than 28 years, pushing 20, whatever, October 91, whatever that, you're the math teacher, help us with that.
Yeah, 29 years.
October 91, so a long time, and in many different iterations, but always as a loan originator. I was a broker for many years, which used to be a wonderful way to get a loan. Now it's not a wonderful way to get a loan. So I work directly for a bank, Fairway. We lend our money, we lend our own money. We don't arrange loans through other people. Gives us a lot of control and gives us a lot of depth in what we do. And we're large enough that we do, you never want to say you do everything because there's always an oddball product out there. So we don't do everything, but we do everything that you guys are going to run into in your market. Very, 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 very familiar with your market. That's where I've been all along. That's my office used to be in Baldwin. My first house was in Rockville Center. My office is now in Freeport.
We're in Freeport right now.
Yes. Hey, this is Amanda. Amanda works with me. She helps me with support. She helps me with marketing. I do work within a team. There's 2 other people on my team. They're not going to join us on the call. But Amanda does some of my frontline stuff, helping me support real estate agents as we do deals and with what we do. So please meet Amanda.
Hi, Amanda.
Nice to meet you guys.
You too.
So
we chatted this morning. Good to see you now.
Yes.
Yeah.
Nice to see people face to face, even in the remote world.
Because Renee's good at a lot of things, but scheduling a meeting and making it all happen and not double booking and, that's not what Renee's good at. So that's where Amanda comes in. And foolishly, I did Amanda's job yesterday and caused myself a problem. But anyway, here we are.
It's all right.
So I want to break this into a couple of different pieces. And you guys get to choose what I want to talk to you guys about what a pre-approval really is and how a pre-approval really should benefit a transaction. I want to talk to you about what's going on in the mortgage world right now and what the COVID-19 is doing to the mortgage world and some of the changes and some of the challenges that we're dealing with in mortgages. And then I want to talk about any transactions that you have pending right now that you're working on today that could give us an opportunity to have a dialogue about a specific transaction. So we're not speaking figuratively and, big picture. We're talking about something actual. So shall I start with what's going on in the mortgage business right now?
That sounds wonderful. And I would appreciate you talking about the pre-approval and the importance of it and the process, because I am working with a few couples right now, or we were beginning to work with a few couples right now who were just getting started, just wondering, I want to buy a house at the end of this year. What should I do? How should I approach it? So it would be
all right, so let's start there. Many times in our world, real estate mortgage world, we're told, buyer needs a pre-approval because we want to make sure the seller understands that you qualify for this loan, and we want to make sure that the seller and the listing agent take your offer seriously. That's a normal, regular kind of comment that you hear around. What I've done over the years is I've kind of flipped the pre-approval. I don't work for the seller. I work directly for the buyer. My goal is to build value for the buyer, and my goal is to convert as many of your leads, your buyers, into buyers, and to make, to end up with a successful transaction. Well, how do we end up with a successful transaction? The way we end up with a successful transaction is we have to educate a buyer about the buying process, about the mortgage process, but really about their numbers. Nobody ever walks into a car dealership and says, what's the most expensive car I can buy today? And sometimes when people call for a pre-approval, they say, well, what's the most I can be qualified for? And nobody shops like that. People go into an Audi dealer and there's an A8 sitting over there that costs $100,000, but they wanted to buy an A5 that costs $50,000. Even if they can afford the $100,000, that's not what they want. They have a goal set up on what they want to buy and what they want to spend and what they want their payment to be, etc. So what I do with a pre-approval is I explain to a buyer, prospective buyer, that I want to educate them on what I consider the two most important numbers in the whole world. The two most important numbers are, what is my monthly payment and how much money do I need to buy this house? Now, within those two most important numbers in the world, there's 1,000 questions. Which program are we using? Are we doing FHA? Are we doing conventional? Is it a VA loan? Is there PMI? Are we putting 20% down? Are we going to pay PMI up front? Are we going to pay PMI monthly? What's the credit score? Which program does this borrower fit better into? Do we need to finance closing costs? So there's a million questions that get baked into those two most important numbers in the world. But when I do a pre-approval and I educate a buyer on those two most important numbers in the world, the byproduct of that discussion is an educated consumer who understands what their monthly payments are, who understands how much money they need to buy that house based on how we structured that transaction, and they become very comfortable with those numbers so that they can go to you guys and say, hey, you know, we want to keep our monthly payment under $4,000. You know, we're going to buy, we have $60,000 that we're going to use to buy. And, you know, they know we worked up a scenario on a $600,000 house where they were putting 5% down, and the other, you know, they needed $26,000 for closing costs. I'm making numbers up, which is $56,000, and it all fit into our parameters. In educating buyers about their numbers, if you home buyers, first-time home buyers are funny because a classic first-time home buyer couple has $140,000 income. She's a police officer. He's a teacher. They got good, solid jobs. COVID-19 hasn't affected them. They're renting an apartment, you know, in someone's house for $1,600, and life is good. And now we sit down with them. They really want to buy in Oceanside because their whole family lives in Oceanside. They know the house they want to buy is $525. And I sit down with them and I figure that, and I say, okay, so your monthly payments could be $3,600, and they immediately fall off the chair. First-time home buyers are typically accustomed to a very small housing payment because they haven't owned yet. And one of the education points is showing them and educating them that not only can they afford the $3,600 from a mortgage guy point of view, because you know they're the one that ultimately has to make the decision because they have to cut the check every month, but I have to show them from a mortgage point of view that they qualify for that payment. What makes up that payment, how the payment works, what's the difference between a $450 house and a $550 house, and you know why buying a house today is a good idea as opposed to trying to wait till they save 20% or 10% or more money and buy a house in the future. And by the way, I don't want to make myself sound like a salesperson. If somebody doesn't qualify, if now is not the right time, if you bring me a buyer and they're just not ready, they don't have the down payment, they don't have a vehicle for which to get the down payment, maybe their credit isn't where it's supposed to be, you know, maybe you have I have one the other day, Nassau County police officer, sounds like a great job, but for the first 5 years, you don't make any money. You know, the starting salary is very, very low, and you don't go to top pay until after 5.5 years. So it takes time, and, you know, you have no overtime in the beginning. So it takes time to develop your income stream so that they qualify for more. If somebody truly doesn't qualify, then we educate them on what they need to do in order to qualify. So we make them into a buyer in the future. I follow up with that buyer. I tell you about that buyer. You get that buyer into your database, and that buyer becomes a buyer down the road. There are people, it's funny because there are people that absolutely just don't qualify. They're just, you know, you wonder why they called you. Like your credit stinks, you have no money, you know, you work part-time, like you sometimes you wonder why the phone call comes in, but you don't judge. And sometimes you have to educate as to what you have to do to get yourself ready. And sometimes people are so overqualified that, you know, it's just, you know, everybody's different. So you have to take every situation. We're making a lot of decisions while we're having those conversations about the monthly payment and how much cash we have to close. We're thinking about conventional versus FHA. We're thinking about 5% down versus 10% down. We're doing a little bit of financial planning. I don't pretend to be a financial planner, but if you have a buyer that has, you know, a large debt load, and that debt load is really keeping them from doing anything, but, you know, somehow they saved up 20% to buy the house, sometimes that buyer is better off putting 10% down, even 5% down, and utilizing those funds to get out of debt, lowering their overall monthly payment, letting them qualify for more of a home, and making them a more confident buyer because their monthly payment went down and now they're more comfortable with the purchase. So we think about those things. I communicate those things to you constantly. Another example, there's something called a seller's concession. A seller's concession is when a seller pays some of a buyer's closing costs. It's a financing tool. Now you say to yourself, what seller is going to pay some of a buyer's closing costs? No seller is going to pay some of a buyer's closing costs. It's something that we negotiate into a deal. You know, you have an accepted offer on a 510 house. Buyer really wants to buy the house. They don't have enough money. If we renegotiate that deal to a 525 purchase price, with the caveat that the seller is going to give the buyer $15,000 at the closing table towards closing costs, maybe we make a deal where a deal didn't happen. I will never do that without speaking to you first, because a seller concession is something that's not always attractive to a seller, and it makes sellers nervous. And the house has to appraise for the higher number. The sale price isn't 510 on that deal. The sale price is 525, and the house has to appraise for 525. So before we do any of that, I would always discuss with you, so that we know that that's available to us on a particular transaction or not. Maybe it's just not, you know, if you have a house that has 41 offers and 35 of them are over asking, that's probably not a house that, you know, deal with a seller concession. You have a house that's been on the market for 4 months and, you know, it's a little bit of a fixer-upper and it's, you know, whatever, but it fits this buyer's need, that might be a perfect house for a seller concession. So while we're talking to these buyers about their income, assets, and credit, all the three pieces that make up a pre-approval, we're thinking about all these different factors and putting a deal together. I don't need you guys to become experts on that because, and you're more than welcome to become experts on it. I don't want to hide the information, but it's a lot. I do it creatively. I do it in a problem-solving way. I do it to try to facilitate a transaction. So we try to, my job is not to say no. My job is to say yes as often as I can. And sometimes, you know, you have to move things around a little bit to make a deal work. So once we've educated a buyer on what their monthly payment is and how much money they need to buy the house, by the way, we verified throughout that process how much the buyer's working with, how much cash they have, where the cash is coming from to make sure it's going to be okay with underwriting. And there's a lot of different places money can come from. You know, I have money in the bank. We're getting married next month, and we're going to have wedding gifts. Dad's giving us a gift. I'm going to borrow from my 401k. I just sold my car. Those are all examples of where money comes from. I'm selling a house to buy a house. Of course, that's a good one. Those are all examples of where money comes from. My tax refund, I got a bonus at work, stuff like that. But attached to every single one of those scenarios. So I need to know what I'm talking about to make sure I put a deal that's going to make it through underwriting, put a deal together that's going to make it through underwriting. While I'm figuring out these numbers, I'm verifying all the borrower's information via their paperwork. A typical package, I mentioned the school teacher and the police officer earlier. That's 4 weeks most recent pay stubs, 2 years tax returns, 2 years W-2s, 3 months most recent bank statements, photo ID, separation agreements, divorce decrees if anybody's divorced and pays or receives alimony or child support. That's a typical ask for paperwork on a pre-approval. I take their application. I'd be happy to tell you the timeline of how I do it, but I don't know if you need that. I take their application, I ask for documents, I receive the documents, we underwrite the documents, I run 3 credit reports on each borrower with their authorization, of course. I calculate all their income in an underwriting way. I look at their assets in an underwriting way. What I mean by that is everything passes underwriter guidelines. And I don't give you my opinion. I know based on my information that I have a deal. I don't lose deals. I don't put a deal together and say, oh, Sasha, we were close on that one, but that one just didn't work. That is totally unacceptable. That is a reputation killer. That is a catastrophe of monumental proportions. I have 2 deals in right now that were clear to close that one of the borrowers lost their job due to COVID-19, 2 separate transactions, and we're scrambling to fix those transactions. Unforeseen stuff that comes up. But as a norm, when we're pre-approving somebody, we're verifying that their income is solid, if we're using overtime, that it meets guidelines, that they have a 2-year track record. And there's 100 different guidelines that we use to verify, and FHA is different from conventional, and VA is different from both of those. So, there's many pieces to the puzzle. So we've taken an application, so we know their information. We've got their paperwork, so we validated everything. We ran credit, so we know what the credit report looks like, and now we have a pre-approval. I can take a step further and add formal underwriting, and if I put the loan through formal underwriting, I can actually generate a commitment letter. So if you have a buyer who's shopping in to be Rockville Center Schools and wants to spend, $575, let's say, that might be a tough buyer, right? Because there's not going to be a lot of houses that meet that buyer's needs. So we know when we go to make an offer that there's going to be 10, 15 offers right behind us. That might be a buyer that we go to the extra step and get an actual commitment letter for. So you can go to the listing agent and say, boom, here's an actual approval. This isn't a pre-approval. This isn't somebody's opinion. This is the real deal. Very happy to do that when you need us to do that. There's some markets in the United States that every single deal is done like that. Our market isn't like that. But if you need that, that's 100% available. So a pre-approval is about verifying information, is about educating a consumer so that a consumer is comfortable engaging in a transaction with you. A couple of things we educate a consumer on. I get this all the time. We do not want to buy a house over $450. And I say, okay. I don't react to that because I hear that a lot. And then, as I get into the numbers and I start figuring out their income, I'll say, well, you mentioned $450. Why $450? Well, because we don't want, and a lot of times they'll make that determination. They don't even know what the monthly payment is. So then I start educating them on the monthly payment. Interest rates have fallen. Interest rates have fallen 0.75% to 1% in the last 90 or 120 days. What people thought they can buy, they can buy much more now. $10,000 today costs $40 a month. Think about that. The difference between a $500,000 mortgage and a $510,000 mortgage is about $40. So I always tell a buyer, especially a first-time home buyer, you should never lose the house of your dreams over $10,000, because $10,000 sounds like a lot of money, but in a 30-year mortgage, it's not a big difference in your monthly payment. Again, not trying to sell anybody anything, but just trying to, when you're asking them to go up $10,000 on that house to lock up that deal, they need to know what that means to their monthly payment, because that's really how they're going to make the decision. So very important that we educate somebody on that. So document, validate, dot our I's and cross our T's, educate the buyer on some of the nuances of what goes on, handle all their questions, what is flood insurance, why do we need it, whatever it is, so the buyer becomes a comfortable buyer and the buyer's ready to go. Everybody knows on this call, when you buy something with an absence of information, it's a scary deal. You go to a restaurant and order something you've never eaten before. It's $22, and you're like, should I order that? I've never had that. It's $22. It's not a big deal. It's not a big commitment, but you don't know what it is. Now imagine you're buying a house, the biggest thing you've ever bought in your life, with a $4,000 monthly payment. You want to know what the differences are. So I try to bring that into the fold. The whole time trying to improve an application. if somebody's just perfect, we have 20% down, we have all our closing costs, we make plenty of money, our credit score is 760, great. Now we just have to go get the best rate that's available and make the terms as attractive as we can and structure the deal in the most attractive way we can so we keep that buyer engaged and keep that buyer going. And sometimes, listen, we have 18 grand, our employment is this, we got a 625 credit score. I'm not going to say no to that buyer. I'm just going to tell you how to do that buyer. It's a different program. It's a different way. It works a little different, but it's totally doable. Don't ever say no to a buyer. Let me say no to the buyer, and let me bring you the information, but don't ever make a judgment call and say no to a buyer, because the most powerful buyer in the world is a truly motivated buyer. I don't care what price range. When somebody's truly motivated to buy a house, where there's a will, there's a way. We figure it out. We'll get it done. And we get it done clean, by the way. That doesn't mean you're 90 days into a transaction, pulling your hair out and biting your fingernails because when's Rene going to finally get this thing done? We figure it all out beforehand. We figure it all out before they make the offer. We have a plan before they make an offer on your house, so we know what's going to happen. We do not put deals together. We do not put deals together on a wing and a prayer. Hey, Sasha, if they pay down their 2 credit cards and their credit score goes up 42 points, this deal's going to work, so take the offer, sign the contract. No, absolutely not. That doesn't happen. Hey, Sasha, they're going to pay down their 2 credit cards. We hope the score's going to come up. They might be ready to buy in a month. That's the way that works. Any questions about a pre-approval?
Maggie?
Okay. You can buy, if you have VA buyers, a VA buyer means one of the borrowers was a veteran. They could buy an $800,000 house with 100% financing.
Mm-hmm.
What? They can. If you have a 2-family house and it's $900,000, $850,000, and you have a buyer that wants to put 3.5% down, they can do that. That's an FHA loan. That's possible. There's many different programs in many different ways. So I'll never ask you to put together a harebrained deal, but again, there's programs out there that work. And to some mainstream people, they say 3.5% down an $800,000 house, that's ridiculous. Well, okay, you might think it is, but it's not. The FHA program is a very, very successful loan program. It started after World War II. When mortgages fell apart 15 years ago, it was one of the only programs that didn't, even though it's always been 3.5% down. They've always documented income. They've always documented assets. They accept borrowers with lower credit scores. The program works. The program is tried and true. So the program is available. So if a borrower fits that program, let's do the deal and get it done.
Do you have a question?
Please.
No, he just answered it. I was just going to ask what would be the lowest down payment that you could put on, not necessarily the lowest, but how low is too low. But you just answered.
You can literally do a VA loan. So here's a problem. You can do a VA. I have a VA loan that's closing today. It's a $350,000 purchase in Rocky Point. It's actually closing right now. We put a $22,000 seller concession on it. The buyer is coming to the closing, and the buyer agreed to pay some of the seller's closing costs because it was a renovation house. The house was completely rebuilt. So the seller's closing costs are a little higher than normal. The seller's closing costs ended up being $26,000. She's bringing $4,000 to the table. She's borrowing $372,000, and the whole deal cost her $4,000. She qualifies, her and her husband qualify by leaps and bounds. It's a clean deal. There's nothing wrong with it. But she spent $4,000 to buy a $372,000 house.
Okay.
So that's about as good as you can get.
Yeah.
FHA, 3.5% down. You can technically finance all the closing costs.
Mm-hmm.
But again, seller concessions are not always well received in the market. So, but it is 3.5% down. You technically can finance the closing costs. You don't have to. Conventional loans are typically 5% down, but there are some caveats with 3% down, but they have income limits. So we typically don't get to use those a lot because the income limit's like $82,000. And we don't have a lot of buyers who make under $82,000 in our world. So conventional technically goes to 3, but it's really 5. FHA goes to 3.5% down. VA goes to 100% financing. Those are your 3 mainstays.
Okay. Thank you.
So that's a pre-approval in a 15 or 18-minute nutshell. Sorry to drag on, but there's a lot to it. It's not, you call Quicken, you call Chase, hey, I want to get pre-approved. Oh, okay, great. What do you do? How much do you make? Hey, the best one is, how's your credit? Oh, good. They don't even run your credit, and they give you a pre-approval, because a pre-approval is just that person's opinion. That's useless, and that's a nightmare, because when we get down the road on that deal's going to explode for some reason or another. We are on the complete opposite end of the spectrum. We get into the nitty gritty. We look at every bank statement. We look at the deposits. We look at the income. We figure it out, because my reputation, when I say yes, it has to be yes. It can't, I'm a little intense with my team sometimes. We're not allowed to fail. If we say we can do a deal, we have to do that deal. So all we have to do is we have to do our homework to make that happen. So when I say it's good, it's good. If you need a pre-approval immediately, sometimes I call somebody. They got 20% down. They got great jobs. I run a quick credit report. They have 800 FICO score. I just know from intuition, and I'll call you and say, hey, this deal is a home run. I don't have any of the documents yet, but take this guy's offer and run with this. He says I'll have the paperwork tonight. I'll call you tomorrow and tell you. Sometimes you just know. And same thing, sometimes I get on the phone, you say, hey, Rene, I got an offer from this buyer. And I call that buyer and I ask a couple of questions. And I'm like, this is a box of rocks. But we still carry it through, and we still get the paperwork, and we still look at it, because, we give everything a shot. But you kind of know which way you're going. And sometimes I'll give you a quick opinion if you're looking to take an offer, because I know I don't want the other guy down the road to make the offer and you to lose the deal. It's all about getting the deal together, right?
It's very important. I really try to educate all my buyers and explain to them what it means for them to have that pre-approval, because we're going to go out, we're going to see that dream house, and you want it now, and there are tons of other people who want it. Let's be ready.
And you're going to lose it.
Ready and have it streamlined so you actually get it.
Yep. And when you go for that pre-approval, and there's 10 offers on that house, and one of them has a Quicken pre-approval, one of them has a MCU, Municipal Credit Union, one of them has a Chase pre-approval, and one of them has my pre-approval. I'm boasting a little bit. My pre-approval will win that deal, because I'm well known. They know I'm local. They know I'm not a big box bank. They know I'm not, some guy on the phone who just gave somebody's opinion. They know I do my homework. So, Sasha, you're 100% right. You guys are driving these people around on Sunday afternoons. Like, that is very, very valuable time that you're using. You want to have a loaded borrower in the back seat of your car. You want to have a borrower who's ready to rip, and a borrower who's pre-approved is a borrower who's ready to rip.
Yeah, I think even for their benefit, that's my biggest thing. Sometimes I tell people, like, listen, we can certainly go look at anything you want. I'll be happy to show it to you, but I don't want you to be heartbroken as a buyer, especially first-time buyers, young couples who are, you have this dream of having a house, and I don't want to see you heartbroken. I don't want to see you.
And you guys handle your sales the way you handle your sales, but I typically advise, you make a new relationship with a new buyer, you take them out once, show them a couple of houses, get their feet wet, and then you have to absolutely insist. And by the way, this comes up a lot. Well, no, I don't need to be pre-approved. I got pre-approved by Quicken.
Yeah, no.
Hey, that's Mr. Buyer, that is wonderful. I appreciate you taking that step. But I want you to understand how I work. I work within a team. I work with people that I trust. I work with people whose opinions I value tremendously. I go to all ends to make my deals happen and to make my deals work. At the end of the day, I don't care where you actually go get your loan. That is your business. You can get your world you want. But I do want you to get pre-approved with my guy, because my guy is going to tell us what we need to do, what we need to know, and my guy is going to get us ready to make this deal. So you're not asking someone to go get their mortgage with me. You're not asking, it doesn't cost a dime. You're just asking them to provide the information so that we know what we're dealing with. the backstory is the minute you get me started with them and I get talking to them and I get their information and we kind of many times I'll have a buyer that's already been pre-approved by, I keep picking on Chase, let's pick on Citibank. I'm already approved by Citibank, and they talk to me because you used that paragraph that I just gave you. I'll say to a buyer flat out, I'm going to say, look, you've already been with Citibank and Citibank already pre-approved you. What I'd like you to do is I'd like you to note the differences in their process and mine. You're going to notice that we take a deeper dive. We go into more detail. You're going to notice that we go much further than they did. And typically that sells a buyer on our service by the end. And we end up doing that deal very, very high percentage of the time. There's a selfish interest in it for us because we only make money when a deal closes. We don't make money when we pre-approve a deal, just like you guys. Ultimately we want to do that deal, but we know our success rides on your success. So if we pre-approve 10 buyers and you end up closing those 10 deals and we don't, well, we got to look at our process because we're dropping the ball somewhere. But that doesn't happen. But, we're here to support you guys any way we can. But our selfish interest is to write the deal. But we're not asking you to force somebody to come with us. We want to earn that right. We want to create enough value that they come to us on their own.
Rene, what have been the changes with COVID and the quarantine and people losing their jobs? What is happening to mortgages?
Well,
interest rate.
You need to have a job. You need to have a job in order to qualify for a loan. So right now we probably have every different scenario that's out there. I told you a couple of deals that were literally cleared to close. Cleared to close means we're done, schedule the closing. One gentleman worked at the New Hyde Park Inn, a catering hall, and he lost his job. So right before a closing, a bank always re-verifies someone's employment. Hey, is Amanda still working there? And if the answer is no, we immediately lock up the brakes. We have a problem. We want to hear yes, because we need Amanda to be working so Amanda can make her mortgage payments. I have people that are currently furloughed, but I know they have the kind of jobs that the minute we get back to work, they're going to go back to work. So that deal can't close until they get back to work. Mm-hmm. I have borrowers that are at half pay for 3 months, and either they qualify on the half pay or the deal can't close until they get back to work. I have borrowers that lost their job, like that New Hyde Park Inn borrower. I don't have high confidence that that person's just going to go back to work when COVID ends, because who's going to the New Hyde Park Inn for a, communion bat mitzvah for a wedding? I don't think anybody for a little while. So we restructured that deal. We found another borrower. We added a co-signer, and we figured that deal out. So we need people to be working. So we have to look at that on these deals, and we have to make sure that people are actually working. If it's a pre-approval and somebody's in a retail position and, a buyer for Macy's, let's say, we know that that person's going to get their job back. Like that person's an executive at Macy's, but we know, so we have a high level of confidence that that's a temporary situation. I'd be communicating this to you guys right along every step of the way. But if I had that deal in process right now, I would just note to self, we can't close until this person's back to work. We're asking way more questions today than we did 90 days ago. Because, $700,000 buyer with 20% down and super perfect credit sounds like a layup. But I'll give you one example. I have a guy who's he owns an ambulance company. He's not an ambulance driver. He owns the whole company. Sounds like he's a busy guy these days, right? Yeah, his ambulance company serves Madison Square Garden, Yankee Stadium, and Shea Stadium.
Oh, wow. Okay.
How you doing? So, that's a guy who really can't buy right now because we don't even know when the next baseball game's going to be, So we do need people working. We are going to deal with some unemployment, but even if unemployment gets to 10%, which would be a pretty unprecedented number, 90% of people are still working. So we have to look at that, and I have to give you guys that information on these deals and say, hey, Maggie's a school teacher. I'm not really worried about that, but this guy's a chef over at the Garden City Hotel, and I'm kind of worried about that. So that's part of our active conversation these days.
Okay.
We do need people working. Other than the we do need people working part, the mortgage business is under some pressure these days because of something called a liquidity crisis. With rates dropping as fast as they did, and with all the uncertainty in the markets, stock market, bond market, mortgage money comes from the sale of bonds. Do you want me to explain that to you, how that works?
Yeah, a little bit, because it's definitely something that's happening right now, and we would love to.
Happening right now. Fairway writes a loan and closes a loan. And let's just say it's a conforming loan. It's a Fannie Mae conventional loan. So that's a $700,000 home with 5% down or 20% down, reasonably good credit. That's what that is. So it's a loan that we write and we close it with our money. But our intention is to securitize that loan through Fannie Mae. So the loan has to meet Fannie Mae's guidelines. And that's why I was talking to you before about overtime and bonuses and large deposits, where the money came from, because everything has to meet the lender, the secondary market's guidelines. So because of everything that's going on, and this forbearance program you're hearing about plays into it because the mortgage business is being affected. The federal government came out and said, hey, we have COVID-19, big problem. So guess what? If you have a mortgage and you're not in a position to pay it, you can take 6 months and not make any mortgage payments.
Yes. Mm-hmm.
Now, it's a poorly designed program because the way the program is written, after the 6 months, you owe the money.
Yes.
Period. If you don't pay the money after 6 months, the bank will give you up to a year to pay it. So that means your mortgage payment is $2,000 a month. You take 6 months off where you don't pay your mortgage. And for the next 12 months, you're going to pay $3,000 a month. The $2,000 that you regularly owe, and the $12,000 back mortgage payments that you owe divided by 12. So you're going to make a mortgage payment of $3,000 a month. And by the way, during the 12 months that you're making these back payments, we're going to record all your payments late. Because we didn't record you late for the 6 months. That was the deal. But now you're in forbearance making up for the past money. We're going to record all those payments late. So it's going to wreak havoc on your credit report. Or we can modify your loan. Modifying your loan is very, very difficult. That's when the bank actually changes the terms on your loan and perhaps adds that to the end of your loan. It's way easier said than done. It's case by case and deal by deal, and it has to be accepted by a bank, and there's no guarantee that they're going to do a dangerous thing. And then for FHA, there's some other insurance that gets built in where they could be what's called a partial claim. So they set up this program. We're not going to get political here, but they set up this program, but nobody ever called the bank. Nobody ever called Chase and Wells and said, hey guys, what if 20% of the people that have mortgages with you just stop paying?
Yeah.
So the mortgage business is reeling by what happens if, and what happens if, and what happens if. It appears that the Fed is going to fix that. Nothing's official yet, but there's a big movement to get the Fed to fix that so that the banks don't take this huge burden on, which will really could potentially really interrupt lending, because it could be a small thing. 2% of people could do a forbearance, and it could be an enormous thing. 20, 30, 40% of people could. And by the way, to get a forbearance, you don't need to qualify for anything. Maggie, I'm not picking on school teachers, but let's say you and your husband are both school teachers. You don't need a forbearance, but you decide, hey, wouldn't it be great? We just not pay our mortgage for 6 months and pay it back later. You don't need to qualify. You don't need to be out of your income. You don't need to have a problem. You don't need a reason. You just need to say, I'm out. So it's a potential big problem for banks, and it's causing a lot of a crunch on some lending, and it's causing some crunch on some of the lower credit score loans, lower down payment loans, different things like that. So it's causing us to look a little bit more carefully at loans in general. Fairway makes a loan, lends our own money. Fairway makes the loan in such a way that we know we can securitize the loan because we've made the loan to certain guidelines. We close the loan with our own money. We then put the loan on what's called a warehouse line. We borrow the money short term, and the loan sits on the warehouse line while we package the loan and securitize it off to the secondary market. That only takes a couple of weeks to do. It's not a big deal, but the money sits on the warehouse line. So because of some of this liquidity stuff, some of the warehouse lines are being compromised. Some of the guidelines are changing on the warehouse lines, and all of this is causing some disruption in mortgage lending. We have not felt any real disruption at Fairway yet, except for jumbo mortgages, which is a loan over $810,600 on a one-family house, bond loans, which is like a Sony Mae loan. We barely ever get to write one of those again because of the income limits, and F8 government loans with FICO scores under 640. We do run into those, and we do have those, but we don't have a lot of those. So right now, it's business as usual, and everything's okay. But the problem we're having on every loan, and the problem we're looking at on every loan, is are these people still working, and is their income interrupted or not? So it's causing us a couple of extra boxes that we have to check off, and we have to be a little bit more careful with. I'm a very optimistic guy. I believe that this thing is going to end, and I believe, a large, very large percentage of our population is going to get back to work. I think it's going to be a boom for real estate, but we do have to get through the short term. Yes. Appraisers don't have to go into houses. So if you do have a deal and we order an appraisal, even if the guidance on the loan, there's something called an AUS approval, automated underwriting system, like an electronic approval on a loan, and that typically tells us what kind of an appraisal we need. Even if that says we need a full appraisal where the appraiser goes through the house, if you were to say to the appraiser, hey, I can't get because of COVID-19, the appraiser will immediately pivot and do it as a desk appraisal. So there's workarounds. Right now, we can't get transcripts. We verify every tax return that we receive with what's called a 4506. We receive transcripts from the IRS. The IRS is closed. There are no transcripts right now, so we have workarounds for that. Schools are closed, so we can't verify employment the way we used to verify employment because the person isn't sitting there that verifies employment. So, there's workarounds for all that stuff, and all that stuff is happening. There's a couple of programs that are temporarily suspended, like I mentioned, jumbos, bonds, and some of the low-score FHAs. But for the most part, lending, I personally have 10 closings between last Friday and this coming Monday. That's just me personally. Fairway, my branch, we're closing loans right along. We're oddly about to have one of our biggest closing months in our history, both at my branch and both Fairway corporate. Fairway is projected to close $5.7 billion worth of loans this month. It's like 75% ahead of April 2019. So it's a little bit counterintuitive that we're in the middle of COVID-19 and we're closing loans like crazy. I got attorneys that have separate rooms set up so people don't have to sit near each other at a closing. I have attorneys that are closing in parking lots. Everybody's sitting in their car. I got attorneys that do it all by FedEx. I got every crazy, and I let the bank attorneys decide what they want to do and how they want to do it. But we got every scenario you can imagine, but deals are still closing and people still want to close them. So things are happening, but everything's a little bit harder.
Wonderful. Those are wonderful things to hear because there's certainly still sellers out there. There's certainly people who are buyers who are looking to buy, who want to buy and are concerned, or people who were close to the process or in the process were concerned. So thank you very much for all this information, very valuable. Thank you for talking about forbearance because that is something that's interesting that you mentioned, right? It seems kind of tempting. Oh, I don't have to pay my mortgage. Okay, let me not pay my mortgage. So it's good to have an understanding of repercussions, actually what's happening. Yes, you will have to pay eventually, and how is that going to affect you? So I would say
we sent out We sent out a great blast the other day of information about forbearance. Amanda, I need you to please make sure that they get that.
Will do.
I put Sasha in my contacts, all the information's there. Maggie, I would need your information so that I can get that to you. It went out as my regular marketing. It's so important that people understand what it is and what it means and how it works, because it's not what it looks like.
Mm-hmm. Yes, it is very important. That's why I think it's important for me as a realtor to talk to you and share it. I try to invite, but you know how short notice of this was, but I have about 4, maybe 5 other couples who were either in the process of looking or thinking, buying right within a year or 2. We're just there. So this would be a great information to share with them. And
Sasha, this is the new normal, right? Every day we're living a new normal because life is just crazy. My dog just walked in. He's like, Dad, what are you doing? Like, can't we go for a walk?
my cat was
the new normal.
back and forth.
They got to check on us. If you want to set up a meeting with a buyer, I would be thrilled to get on a Zoom meeting with as many buyers as you want. We could talk. What do you want me to cover? What do you want them to learn? This is how this is our let's grab a cup of coffee and talk about business. We can't do that today, right? So this is our cup of coffee. Yeah, I had mine already. Amanda probably on her 14th cup by now. It's the thing we do, but I'm open to that. Please mention it, schedule it. I'm happy to jump on those. I'm actually on those all day long. I'm in Windham, New York right now. I'm 3 hours north. I'm social distancing. I'm exponentially socially distancing. I did not see a human from Friday evening to Sunday evening. I was out walking my dog and I saw my first humans in 2 days. So, you know, this is my contact with the world. So if you want to talk to a buyer, please, I'm available 100%.
That sounds great. Maggie, do you have any questions?
I have one question. Is it up to you, or is it completely up to the lender on what kind of loan that you get? Like when you were talking about FHA and all those kinds of things, is it just up to your scenario that it pops out that way?
That's a wonderful question, Maggie. It's not up to the lender. I don't get to decide. There are some lenders. FHA loans are more valuable to a lender than conventional loans are. You know, okay. 6% listings are more valuable than 4% listings, right? Mm-hmm. But it would be totally unethical and totally wrong and totally against 4 million different laws for me to push somebody to an FHA loan. There are reasons. If you have a buyer who's putting 10% down and they have a 655 credit score, on a conventional mortgage, conventional mortgages, the pricing for the rate and the cost of the PMI are both risk-based. Risk-based means, just like think about car insurance. Amanda has 2 DWIs and 2 speeding tickets where she was going 100 miles an hour. Can you believe it? Maggie's driving record is perfect. After all that coffee. Maggie's driving record is perfect. So Maggie's going to get lower car and cheaper car insurance than Amanda is. That's risk-based. Mortgage rates work the same way on conventional loans. So with a 655 credit score, that conventional loan is going to be very expensive, probably 0.75% higher than the best rate in the market. On top of that, the PMI insurance, private mortgage insurance, because we're putting less than 20% down, is going to be way more expensive than the best case scenario. But on an FHA loan, they qualify for the best rate available. And on FHA, it's called MIP, Mortgage Insurance Premium, same thing. It's just PMI means non-government, MIP means government. The MIP is fixed. The premium is static, so everybody gets the same one. So on a 655 deal with 10% down, an FHA loan will just work much better for that buyer than a conventional loan will. So it's not about who chooses it. It shouldn't work like that. If a borrower is savvy and a borrower did their homework, they're going to prefer a conventional mortgage over an FHA mortgage. The main reason being, when there's mortgage insurance involved on a conventional mortgage, you can get rid of the mortgage insurance early by virtue of the fact that the house appreciates in value. On an FHA loan, you cannot. It's fixed. With 10% down on an FHA loan, the MIP, would be all years, no matter what.
Mm-hmm.
So a conventional loan is more attractive, but in that case, a conventional loan will be waived in two regards. So an FHA loan would work much, much better. That's an example of how we make those decisions.
Okay. And the appraisal of the house, say that you're buying a house way under the appraisal value of that house. How does that work?
Okay. In many ways, New York is the worst state in the country to get a mortgage in because our closing costs are high. And I talk to people in Tennessee, and they're just like, your closing costs are what? Your taxes, like they can't believe the numbers.
Right.
But New York has one thing that we're the only state in the union that has this. It is unlawful in the state of New York for a bank to have PMI on a loan where the loan to value is less than 80%. So all you have to do is prove that the loan to value is under 80%. You'd get an appraisal. So if a buyer, and here's back to your question, a buyer is buying a house for $500,000. The house appraises for $600,000. The buyer is putting down 5%. So the loan amount is $475,000. Loan to value is the loan amount, $475,000, divided by the appraised value, $600,000. So that math would work out to 79%. So even though the buyer is only putting down 5%, there would never be PMI on that loan by virtue of the high appraisal. However, FHA is a government program, and that's not how FHA works.
Right.
FHA, it's the lower of the appraised value of the purchase price. So only on a conventional loan can we avoid paying PMI altogether, even with a small down payment, if a house overappraises.
Got it. Okay,
Long
cool.
answer to a short question.
Yeah, that was good though. I needed that info.
Okay.
Thanks.
Wonderful. Thank you so much, Rene.
Yeah, this
Guys,
is great.
anything you ever need, any question you have, anything, as you can see, I like to explain things and I like to make you understand them. The more you understand them, the more powerful you're going to be and the more successful you're going to be, and we want that.
And we want to take care of our people. I have a few people who are very excited to watch this. They couldn't join us, but I'm going to be sharing this video, and just from having conversations, because that was the conversations that we had literally maybe 2 months ago, where a friend was like, I'm thinking of buying a house in a year. What should I start doing? Mm-hmm. I was like, okay, talk to a mortgage person, figure out your monthly payments, literally everything you covered today. And then her family got sick, she got sick, and it just so I was like, here, I'll bring it to you. I'll bring the mortgage person to you.